What's going on, everybody? Welcome back to Make Your Own Luck Mondays. And again, this was a YouTube channel that I just recently launched, and I try to take topics around personal finance and investing and saving and different things like that, and try to just break them down and make them easy to talk about. Complicated topics, and just break them down. And that's how I learn. That's how I understand things. So if I can kind of take these things I understand and make them easy to talk about, I figured I'd be the only dude doing that out here. Everybody else seems pretty, in the weeds with this stuff. So today's topic, definitely somewhat complicated. It's to talk about retirement accounts. And there's a lot around retirement accounts, and I definitely would urge you to do a ton of research on your own, as well as, maybe get with a financial advisor or an accountant, because there's just a ton around, whether it be your income levels and what you can contribute, or your tax brackets and how that all works. So that being said, I'm going to talk about kind of the top three, or what I consider the top three retirement accounts, and just give you kind of the high level stuff around them. So the first one is the Roth IRA. So the Roth IRA is really good if you're young. And what I mean by that is when you're not making all that much money. Because what happens with the Roth is you don't get any tax breaks with the Roth, but what you do get, you can put up to $6,000 a year into the Roth IRA account. And then when you're 59 and a half, you can take that money out tax-free, which is gangster. But what you want to think about there is when you're young, you're not making all that much money. You put as much in as you can. If you think later down the road in your 50s and 60s and all that you're going to be balling, that you're going to be making all kinds of money, you're going to be in a super high tax bracket, then it makes total sense to do a Roth IRA, because you're not going to get taxed on that money down the road. So just do it that way. Another thing to think about on the Roth IRA, which is kind of a pro and a con, is the fact that you can take money out of it if need be and not get a penalty. So typically there's a 10% penalty with taking money out of 401ks and traditional IRAs. But with a Roth IRA, anything you contribute, so anything you put in the account, you can take that money out and not get hit with a penalty. Like I said before, it's a pro and a con, because these accounts should never be piggy banks. It should never be a lifeline for you to go and try to take money out of these things. But that being said, if you have some life-altering situation, medical, this, that, and you have to go and take money out, if you take out what you put in, you don't get any sort of penalties. If you have to wipe the entire account out and take all the profits as well, you'll get a 10% whack on the profits. So that's kind of the pro and the con. And then the other con, like I said in the beginning, is it's not tax deductible. So that's kind of the basics of a Roth IRA. And let's talk now about the traditional IRA. So traditional is kind of the opposite, where if you're making a bunch of money in your younger years, whether that be your 20s, 30s, and all that, and you're killing it, you have a super good career, it might make sense for you, because you can deduct that on your taxes. You can deduct your contributions into a traditional to take that deduction now, and then later down the road, you'd basically be assuming that, hey, I made all this money now, so you probably don't have a house to pay off or anything like that. So in your 60s and 70s, in kind of your retirement years, you can take that money out and get taxed on it, but you'll be taxed on it for the income bracket that you're in then. So if you're in a lower income bracket in your later years, you'll get taxed on it then. So it might make sense to take the deduction now and get taxed later. Same situation with the Roth. You can put up to $6,000 a year, and there's some stuff around that. Sometimes you can only put in partial because you make too much money or whatnot. But like I said before, you can get with somebody who can get you into the weeds with that. So that's a traditional IRA versus the Roth IRA, and kind of the two main differences there. One's tax deferred, they call it. The traditional one is tax deferred, so you pay your taxes later. And the other one, you take all your money out tax-free down the road. And the last one I'm going to talk about is the 401k. So the 401k is a company-issued retirement account. And the biggest thing to think about here is if your company does a match. So if they do a matching 401k, always do this, no matter what the percentage is, 5%, 7%, 10%. If they do a match, do the match, because it's free money. So basically, if they're like, hey, out of your paycheck, we're going to say 10% of whatever you're going to contribute, we will put 10% as well. It makes all the sense in the world. So definitely do a matching 401k. The other positive to a 401k is that you can put up to 19 grand a year in it. So you're not capped like the other two where that you can only put a maximum of $6,000. A 401k, you can put 19 grand in a year. So you're able to really make some moves and put a lot of money away, which is awesome. It's very similar to the traditional, same deal. You actually take a tax deduction on your 401k account. So later down the road, you'll be paying taxes on that. And then you have to start taking distributions at 70 and a half years old. Same with the traditional, actually. So that's another difference between those two and the Roth. The Roth, you can contribute forever. 59 and a half, you can start to take the money, but you can keep contributing. The traditional IRA and the 401k at 70 and a half, you have to start taking distributions. So that's something to note as well. But hopefully that gives you kind of just a very broad scope of these retirement accounts. And if there's one thing to just kind of say through this whole thing, whichever one's right for you is for you to figure out, but you just have to start. You have to have a retirement account going, and you have to be contributing to a retirement account on a very consistent basis. Most of these you have till April 15th of, right around the tax year to put your money into them. So do whatever you can to try to max these things out year in and year out. And you'll definitely thank me later down the road. So that's all I got for this week. We will see you guys next week on Make Your Own Luck Mondays. Thanks. See ya.